You're sitting at your kitchen table on a Sunday morning. Coffee's gone cold, there's a calculator in front of you, a notebook with numbers scratched out and rewritten, and you're doing the math one more time because it doesn't make sense. You've worked for 15 years, made decent money, paid your bills, never bought anything crazy, and somehow you have $11,000 saved. 11,000. After 15 years of trading your life for a paycheck, you run the numbers again thinking you missed something. You didn't. The math is correct. The money just evaporated. And the worst part? You have no idea when this ends. No idea when you can stop. No specific date circled on a calendar. Just a vague hope that someday, somehow, you'll have enough. Except here's what nobody tells you. There is a specific date, a calculable moment in time when work becomes mathematically optional. And most people will never find it because they're focused on the wrong line. My name is Alex, and for the last decade, I've been studying the financial patterns of people who actually escaped the paycheck trap versus those who worked until they physically couldn't anymore. And what I found is that the difference isn't income. It's not luck. It's understanding that you have two lines in your financial life, and everything changes the moment they cross. If you want to know your exact crossover date and how to move it closer, make sure to hit that subscribe button and give this video a thumbs up. The average American will earn approximately $1.7 million over their working lifetime, according to Social Security Administration research on lifetime earnings. That's 90,000 hours across 45 years. 90,000 hours. And yet the Federal Reserve's 2022 Survey of Consumer Finances found that 54% of American households have no dedicated retirement savings whatsoever. Zero. The median American between ages 55 and 64, people who can see retirement on the horizon, has saved $185,000 according to Kiplinger's June 2025 analysis. Now do that math. Someone earns $1.7 million over their lifetime and ends up with $185,000. That's an 89% evaporation rate. Where did the money go? It went to living. $6,545 per month in average household expenses, according to the Bureau of Labor Statistics' 2024 Consumer Expenditure Survey. That's $78,535 every single year. For decades, the money flowed through their hands like water through a screen door. But here's the thing nobody explains. There's a specific calculable date when you could stop working forever. Not someday when you feel ready. Not when you hit some vague number that sounds big. An actual date on the calendar that exists right now in your future, and you can calculate it today using a concept from a 1992 book called Your Money or Your Life by Vicki Robin and Joe Dominguez. They called it the crossover point, and it's the simplest, most powerful financial framework most people never learn. Here's how it works. You have two financial lines in your life. One is your expenses, what it costs you to exist month after month, year after year. Rent or mortgage, utilities, food, insurance, gas, all of it. For most people, that line is relatively flat. Sure, it goes up with inflation, maybe increases when you have kids, or decreases when you pay off debts, but it's mostly predictable. Let's say you spend $4,500 per month, $54,000 per year. That's your expense line. Now the second line is your investment income, not your salary, not money you earn by working. Your money generates passively, dividends, interest, capital appreciation that you can withdraw. For most people starting out, this line is basically zero. Maybe you have $5,000 in a savings account earning 4%. That's $200 per year, $16.67 per month. That's not covering your electric bill, that's not covering anything. But here's what compound interest does over time. That second line doesn't grow in a straight diagonal, it curves upward, exponentially. The more you save, the more your money earns. The more it earns, the faster it grows. And the crossover point is the exact moment, the specific date on the calendar, when your investment income line crosses above your expense line. When your money generates more than you need to live. When work becomes mathematically optional. That's not retirement in some distant foggy future. That's financial independence. And there's a calculable path to get there that most people never see because they're too busy focusing on earning more instead of watching the gap between those two lines. Let's put 2025 numbers on this and walk through what this actually looks like in real life. The average American household spends $6,545 per month according to the Bureau of Labor Statistics. That's $78,535 annually. Now there's something called the 4% rule that comes from a landmark 1998 study by professors at Trinity University. They analyzed historical market data and found that if you withdraw 4% of your portfolio in year 1, then adjust that amount for inflation every year after, your money survives at least 30 years 95% of the time with a balanced stock and bond portfolio. Which means if you need $78,535 per year, you need 25 times that amount invested. 25 times $78,535 is $1.96 million. That's your crossover number at average American spending levels. But here's the first leverage point most people miss. You're probably not average. The median household income in 2024 was $83,730 according to the U.S. Census Bureau's September 2025 report, Income in the United States. If you're earning median income, you're definitely not spending $78,535 annually, or you'd have almost nothing left to save. Let's say your actual expenses are $4,500 per month. That's $54,000 annually. Now your crossover number drops to $1.35 million. Still substantial, still requires discipline and time, but that's 31% lower than the average expense scenario. You just shaved $610,000 off your target by spending less than average. That's the first insight. Your crossover number is determined by your expenses, not your income. Now let's model someone who's 30 years old today, earning median household income and investing $800 per month. That's roughly 11.5% of gross income, which is close to the 14.2% total 401k savings rate that Kiplinger reported for Q3 2025 when you include employer matches. We'll use the S&P 500's historical compound annual growth rate of approximately 10% with dividends reinvested. The Motley Fool analyzed 97 years of data through October 2025 and found the 10% figure holds remarkably consistent over long periods despite crashes, recessions, and bear markets. So what happens to our 30-year-old investing $800 per month at 10% annual returns? After 10 years at age 40, the portfolio is worth approximately $163,000. At a 4% withdrawal rate, that generates $6,520 per year or $543 per month. Your $4,500 monthly expenses, not even close to covered. You're at 12% of where you need to be. After 20 years at age 50, the portfolio has grown to approximately $580,000. Now we're getting somewhere. Investment income at 4% withdrawal is $23,200 annually, $1,933 per month. You're covering 43% of your expenses passively. Work is still very much required, but you can feel the momentum building. After 25 years at age 55, you're sitting on approximately $1.06 million. Investment income is $42,400 annually, $3,533 per month. You're at 78% of expenses covered. You can almost taste it. And then somewhere between year 28 and 29, between ages 58 and 59, your portfolio crosses $1.35 million. The lines cross. Your investment income exceeds your expenses. Work becomes optional, not because you're old, not because someone decided 65 is the magic age, but because the math says so. That's your crossover date, and you can calculate it right now with your real numbers. Now here's where this gets really interesting, and this is the part that took me years to fully understand. What I'm about to show you next is the thing that changes everything about how you approach this timeline. The crossover equation has two variables: portfolio size and expenses. Most people focus exclusively on growing the portfolio. Save more, invest more, wait decades. That's the standard advice. But expenses work in reverse with devastating efficiency. Every single dollar you permanently cut from your monthly spending reduces your crossover number by $300. Here's why. At a 4% withdrawal rate, you need 25 times your annual expenses. $1 per month times 12 months times 25 equals $300. If you reduce your spending from $4,500 to $3,500 per month, you just cut $12,000 from annual expenses. That drops your crossover number from $1.35 million to $1.05 million, a $300,000 reduction. At our $800 per month investment rate, that's roughly 6 years of working you just eliminated by cutting $1,000 from monthly expenses. But there's a compounding effect here that most people completely miss. When you cut $1,000 from monthly expenses, you don't just lower your target number. You also have $1,000 more available to invest if you choose. If cutting expenses lets you invest $1,600 per month instead of $800, you're attacking both sides of the equation simultaneously. Your crossover number drops and your timeline accelerates. This is why early retirees who understand this framework obsess over expense optimization, not because they're cheap, because they understand the mathematics of leverage. $1,000 per month in reduced expenses is worth more than a $10,000 raise when you factor in taxes and the reduction to your crossover number. Let me give you a concrete example. Let's say you're spending $500 per month on a car payment for a vehicle that's worth $42,000. You owe $35,000. The interest rate is 6.5%, which was common in 2024 according to automotive lending data. That's a 6-year loan. Now imagine you sell that car, pay off the loan with the $7,000 in equity, and buy a $15,000 reliable used car in cash. You just eliminated $500 per month in expenses. That reduces your annual expenses by $6,000. At 25 times multiplier, your crossover number drops by $150,000, and you have $500 per month to invest, accelerating your timeline even further. That one decision, selling the expensive car, might move your crossover date 5 years closer. 5 years of your life you don't have to trade for a paycheck. Because of one decision about a vehicle. Now I know what you're thinking. But Alex, what about market crashes? What about sequence of returns risk? What if I retire right before another 2008? Fair questions. Let's talk about the 4% rule because your entire financial independence plan depends on whether it actually works. The original Trinity study tested portfolios from 1926 to 1995. They looked at every possible 30-year retirement period in that dataset and found that a 50-50 stock-bond portfolio survived with a 4% initial withdrawal rate 95% of the time. You'd adjust that withdrawal for inflation each year, and in 95 out of 100 historical scenarios, you'd never run out of money. Updated simulations through 2024 data, like those published by the Poor Swiss in August 2025, show similar results. With 50% or more allocated to stocks, a 4% withdrawal rate has historically survived 30-year periods with very high probability. However, and this is critical, when you extend to 40 or 50 years, relevant for someone retiring at 55 or earlier, the success rate drops. A 3.5% withdrawal rate proves more robust for longer time horizons. What does that mean for your crossover number? At 3.5% instead of 4%, you need approximately 28.6 times your annual expenses instead of 25 times. For $54,000 in annual expenses, that's $1.54 million instead of $1.35 million. More conservative, yes, but mathematically safer for a 40-year retirement horizon starting at 55. This is the trade-off. Faster independence with slightly higher risk at 4%, or a bit longer accumulation phase with more certainty at 3.5%. And here's what the numbers don't show, but the psychology does. We're about halfway through, and if you've stuck with me this far, you're already thinking differently than 90% of people. But don't stop now, because what comes next is how all these pieces actually work together as a system. Bankrate's 2025 Retirement Savings Survey found that 58% of American workers say their retirement savings are behind where they should be. 37% significantly behind, 21% slightly behind. The Federal Reserve's 2025 report on economic well-being found that only 35% of non-retirees think their retirement saving is on track. These aren't lazy people. These aren't people who don't care. They're paralyzed by vagueness. They have no specific number to aim for, no calculable date to work toward, no clear feedback on whether they're making progress, just a gnawing anxiety that they're probably not doing enough. The crossover point transforms that abstract anxiety into a concrete engineering problem. When you know you need $1.35 million and you're at $163,000, you're not vaguely behind in some undefined way. You're 12% of the way there. You can calculate exactly what changes would accelerate your timeline. That psychological shift, from helpless to strategic, changes everything about how you make financial decisions. There's a variant of this called Coast Fire that illustrates the power of early momentum. Coast Fire means you've saved enough that compound interest alone will grow your current portfolio to your crossover number by traditional retirement age, even if you never invest another dollar. You've punched your ticket. The math works like this. At 10% annual returns, money doubles approximately every 7.2 years. That's the rule of 72. If you need 1.35 million at age 65 and you're currently 35, that's 30 years, or roughly 4.2 doubling periods. Work backward. 1.35 million divided by 2 to the power of 4.2 equals approximately $73,600. If you're 35 with 73,600 invested, you could theoretically stop contributing entirely and still reach your number through compound growth alone. Now, that doesn't mean you should stop investing. Continuing accelerates the timeline dramatically, but it illustrates how the crossover point creates options and psychological relief long before you actually reach it. But let me address the elephant in the room. What about Social Security? The Social Security Administration reported in November 2025 that the average monthly retirement benefit is approximately $2,013. That's roughly $24,156 per year. For January 2026, the estimated average rises to $2,071 after a 2.8% cost of living adjustment. That represents significant supplemental income. But here's the problem. Bankrate's 2025 Social Security survey found that 52% of Americans who haven't retired expect to rely on Social Security for necessary expenses, not supplemental, necessary expenses. Meanwhile, 76% are concerned they won't receive full promised benefits. The Social Security Trustees Report projects that a 23% benefit cut could occur around 2033 when the trust funds face potential depletion. Maybe Congress fixes it. Maybe they don't. But prudent crossover point planning treats Social Security as a bonus, not a foundation. If your crossover number covers 100% of expenses from your portfolio, Social Security becomes purely supplementary, reducing your actual withdrawal rate well below 4% and dramatically increasing portfolio longevity. Let me show you what volatility actually does during the accumulation phase, because this might be the most counterintuitive part of the entire framework. The S&P 500 has experienced average bear market declines of roughly 33% historically, occurring approximately every 3 to 4 years. Stocks go down, sometimes violently, sometimes for years. This volatility is already baked into that 10% average annual return figure. That average includes 2008 when the market dropped 37%, the dot-com crash from 2000 to 2002 when it fell, 49% cumulatively, the 1973 to 74 crash with a 48% decline, and every other crash in the 97-year dataset. The 10% average isn't theoretical. It's what actually happened, including all the disasters. But here's the key insight that stops people from panicking. During the accumulation phase before you reach crossover, market crashes are mathematically beneficial to you. You're buying more shares at lower prices every single month through dollar cost averaging. When the market drops 30% and you keep investing $800 per month, you're buying 30% more shares than you were before the crash. When it recovers, and historically it always has over sufficient time horizons, those shares you bought at discount prices grow back to full value and beyond. Dollar cost averaging through downturns is one of the most powerful wealth-building mechanisms available to ordinary investors. But it only works if you don't panic sell. Understanding the crossover point helps psychologically. You're not watching your net worth fluctuate for entertainment or anxiety. You're watching the gap between two lines slowly close, knowing temporary setbacks don't change the mathematical inevitability of where you're heading if you stick with the plan. Now let me tie all of this together, because when you see how these pieces connect, everything about your relationship with money changes. You have two lines, expenses and investment income. Your crossover point is when investment income exceeds expenses. You can move that date closer by attacking from both sides. Lower your expenses, which reduces your target number and frees up capital to invest. Increase your investment rate, which accelerates portfolio growth. Time and compound interest do the heavy lifting, but you control the timeline through your decisions today. Every financial choice you make either moves you toward the crossover point or away from it. That $6 coffee every morning, $2,100 per year. At 25 times, that's $52,500 added to your crossover number. That streaming service you forgot about, $15 per month, $180 annually, $4,500 on your crossover number. Now, I'm not saying never spend money on things you enjoy. I'm saying understand the math, understand the trade-off. Every dollar you spend permanently requires $25 to $28 invested to support it forever. Is the coffee worth it? Maybe, but it's not a $3 decision. It's a $75 decision when you factor in the crossover math. Most people never see it that way. They make 1,000 small spending decisions with no understanding of the compound effect on their timeline. The average American will earn $1.7 million over their working lifetime and end up almost completely dependent on Social Security, which pays roughly $2,000 per month. That's less than a third of average American monthly expenses. They'll have traded 90,000 hours of their finite life, their only non-renewable resource, for money that evaporated. They'll work until their body gives out. Not because they're stupid, not because they didn't care, but because nobody ever showed them the two lines. Nobody ever explained the crossover point. Nobody ever gave them a specific target number and a calculable date. You now have what they don't. You understand that financial independence isn't about a feeling or a vague someday. It's arithmetic. It's two lines on a graph, and the moment they cross, everything changes. Not your lifestyle necessarily, but your options, your freedom, your relationship with work. It stops being something you have to do to survive and becomes something you choose to do because it adds value to your life. That's the difference. That's the point. That's the point. That's the point. Northwestern Mutual's 2025 Planning in Progress study found that Americans believe they need $1.26 million to retire comfortably. That number isn't random. It's eerily close to what the crossover math actually says for median American expenses, which means people instinctively understand the scale of what they need. They just don't have a roadmap to get there. They don't have the framework. Now you do. Calculate your actual monthly expenses. Be honest. Track them for 3 months if you need to. Multiply by 12 for annual expenses. Multiply by 25 for your 4% crossover number, or by 28.6 for the more conservative 3.5% number. That's your target. Now look at your current portfolio value. Calculate the gap. Figure out how much you can realistically invest per month. Use a compound interest calculator with 10% annual returns. Find your crossover date. That date exists right now. It's on the calendar. And every decision you make either moves it closer or pushes it further away. The lines always cross for people who execute this consistently. It's not magic, it's not luck, it's just math and time and discipline. But most people never stick with it because they don't have the clarity of a specific target and a calculable timeline. You do now. Your crossover date is waiting. The only question is whether you're going to do the work to reach it or whether you'll be part of the 54% with nothing saved, wondering where the money went. 10 years from now, you're going to be somewhere. You're going to have made 10 years worth of financial decisions. Those decisions will either have moved you toward the crossover point or kept you in the exact same place you are right now, just 10 years older. Your future self is counting on the decisions you make today. Not tomorrow, not next month when you get that raise. Today. Because the crossover point doesn't care about your intentions, it cares about your actions. What financial topic is keeping you up at 3 a.m. that you can't find a straight answer on? Taxes, real estate, inflation, the market, specific investment strategies? Tell me in the comments. That's what this channel is for. Breaking down the financial concepts that actually matter into frameworks you can use immediately. That 89% evaporation rate, that's not destiny. That's what happens when you don't have a target. You now have the target. You have the framework. You have the math. The crossover point is real. The date is calculable. And work becomes optional the moment those two lines cross. Everything you do from this point forward either brings that date closer or pushes it away. Choose accordingly.